Hey, it's Stuart. I've been asked, are there any fees associated with switching super funds? So going from one industry fund to another, for example. Now, of course, you need to think about things like insurances. If insurances are attached to your super account and you go and move to another fund, that insurance disappears. So you'd certainly want to leave, if you wanted to replicate the insurance in the new fund, what I would recommend is leave a minimum balance in your old fund just to preserve that insurance, roll over your monies and apply for replacement insurance cover. Once that replacement insurance cover is in place, then you can go ahead and close the other account and roll the remaining monies over. So insurance is certainly something to think about. But really the question was, are there any fees or taxation considerations you need to be aware of moving from one fund to the next? So theoretically, for example, could I move superannuation funds every year and would have any negative consequences? Well, I can't say for absolutely certain because of course there's going to be other super funds out there. They're going to behave differently, or some super funds, they're not common, but taxed differently, for example. So rolling your monies out are going to be problematic. They're in fact called untaxed super funds, where the contributions aren't taxed when they enter the fund, but only when you withdraw the benefit. Again, these super funds aren't common, I should say. So my response is really general advice, of course, but if you're using some of the really large, well-known industry super funds, my answer applies in that situation. These industry super funds are what's called pooled investment products, which means that the super funds have a bunch of investments, and you have a unitized ownership of those investments. And each day, the fund has to calculate what the unit price is worth, which is obviously going to tell you what your super balance is worth. And that funds must then subtract any unrealized capital gains or any taxation consequences associated with those investments at the end of every day. That means you're essentially paying tax out of your account every day, even though the fund may not have bought and sold investments. And the reason that's important is that if a member leaves that fund, the remaining members would have to pick up that bill, that taxation bill, eventually. But it also means that you can switch between super funds and there's no tax consequences. So if you're going from one pooled fund to another pooled fund, so that's really any of the well-known industry super funds, there's no negative tax consequences associated with doing that. And also, as far as I'm aware, there's no rollover fees associated with doing that as well. Now, some funds might restrict the amount of rollovers that you can make during a financial year. But again, it's not like most people switch every month or anything like that. So you should feel okay to move your super around if the current fund that you're using doesn't suit your circumstances anymore, either because the fees are too high, the returns are no good. Now, remember, if you're going to move on returns, you want to take a long-term view. It's possible that you could have a great fund, but they just haven't had a great year. But the way that they approach investing should hopefully generate or maximize long-term returns. So it's important to really focus on those longer-term returns rather than the shorter run. But if they've underperformed consistently for many years, then certainly there might be a reason to move. So there's no negatives that I'm aware of that would prevent you from moving superannuation funds almost as regularly as you like. I hope that answers your question. Cheers.